Now, Stanlib Resources Fund aims to provide steady growth of income and capital and reasonable level of current income and stability for capital invested. Investments are made primarily in mining, metals, minerals, commodities and related securities. Joining us now in the studio to expand is Kobus Nell, Resources Analyst at Stanlib. Kobus, thanks for your time. I was looking at the numbers, and not your numbers, but numbers that were provided by another fund manager, and you're showing me the gold sector and the precious metal sector. So that suppose includes platinum under pressure. I mean, I'm seeing returns here for Anglo-American on the year down 6%, Sasol down 6.8%, same for Goldfields, etc. It's a tough job being in that sector. What keeps you optimistic?
Look, I mean, it has been a very volatile ride, I think, since last year, when you had sort of the euphoria into gold in 2011. To the latter part, a lot of people started to move out of that as better growth data started to come out of the US, and people sort of had the expectation that rates may be on the increase. And after that, obviously, we've had gold selling off again towards literally to about a month ago, even shorter, and then all of a sudden, the gold sector just shot up, at the expense of the platinum sector. The platinum shares have absolutely been hammered over the last month or so. It's been on the back foot, I think for some time now, but there's and as we've seen obviously in the news now, a lot of news flow on the theme and potential restructuring. You
need your seatbelt.
Absolutely, yeah.
You can't be riding around. So give us a sense in terms of constructing this fund. What would you be looking at? What would be your thinking?
Okay, so we at Stanlib, believe in research, obviously, and we do in-depth research on the companies, and we basically look for the characteristics that basically satisfies our requirements as a house. So we've got a fixed structure from where we do our work from, and then we apply obviously our knowledge and our experience as a three-man team at the moment on the valuations of these companies. And ultimately, then we try and get up on companies, because I guess in the resources sector many times companies can look very attractive, can look very cheap, but many times it's actually a warning sign of what actually is still to come. And ultimately, I guess we focus on trying to align ourselves to not just to the companies, but also the underlying commodities where we think is well supported in that environment.
Yeah. Now look at just the sector allocations. I'm seeing mining, you've got 74.6%, oil and gas is 15.5%. Your top holdings, Anglo-American, BHP, Sasol, Exxaro, African Rainbow Minerals. What are you looking at there? What are the major themes that are helping you in constructing your portfolio that way?
Look, our biggest overweights from the bunch that you named is probably Exxaro and African Rainbow Minerals. And sort of to start off with Exxaro, it's a company that's, from its coal perspective, that's got potential from a structural perspective to improve its returns. With the Medupi contracts that's going to come into play, and we expect that's going to lift the sort of the return profile of their coal business. And then obviously it's exposed to with its 20% holding in the Kumba iron ore assets, and it's enjoying the dividend out of that 20% holding, and not necessarily getting or got the rating I think that Kumba actually got out of it. And lastly, obviously it's exposed to mineral sands. It's been a topic that's been very hot of late, but we believe it's maybe a commodity that's more in the earlier side or stage of its cycle, and it's a sector or area of the company that can support margins and earnings in an environment where which can get very tough.
I go back. If I think back 25 years, the number of resources listings on the JSE has shrunk. I mean, I can remember the days when close to 800 companies in total were listed on the JSE. We're down to about half that number now. And in the mining sector, we've seen a lot of consolidation, and a number of smaller companies have been included in larger companies like Anglo, or they've disappeared. So if I look at the top 5 holdings, it's pretty much as good as it gets for investing in the JSE if you want exposure to metals and minerals. Which begs the question, your portfolio is not too different to many of the others out there. Are you able to have overseas exposure? Toronto Exchange, for instance, ASX, where your scope for exposure to resources is perhaps somewhat greater than we have here, where if you take the BHPs and the Anglos, in it you've got a basket of a hell of a lot of stuff. Sure. So it becomes a global economy story rather than a certain asset class story as such as coal specifically, a play on that, or gold, whatever it might be.
Yeah. Look, our gold and precious metal fund is currently exposed almost 25% to global equities and physical metal holdings. So on that front, we are definitely investing into the broader universe, trying to identify the companies on a global basis that will be the outperformers in a global context. On our resources fund, at the moment, it is a fund that's at the moment restricted to South Africa, so it's more a local fund.
Yes.
You raised a valid point. I guess in the end of the day, the mining, is across the world, and many of these companies have got assets across the world. So even though they're listing and they've got multiple listings, etc., the likes of Rio and Xstrata are the other big ones, I guess, which you can name,
yes.
which obviously you don't have as a local investor access to, and then you get many small ones, that range from exploration guys, obviously straight through the chain. I guess when we do invest in these companies as well, we're very conscious of the fact of where the operations are. What is the challenges in those areas where they're operating, and the potential returns we can expect out of
the
that.
actual refrain I often hear from overseas investors in Toronto or Australia or in the United Kingdom is that South African fund managers are very risk averse when it comes to resources. You see that when they're looking to raise capital.
Are you risk averse, Kobus?
So,
well, you've got to be at times.
So, you get a myriad of juniors and exploration companies and earlier stage stocks in Toronto or London or Sydney that appeal to these investors in those countries, but which would struggle, it would seem, in the South African sphere. Forbes Coal was a case in point, which is listed in Toronto. But when you speak to South African fund managers, it's a case of, well, come back to see us when you're Kumba size type thing. Is that a valid observation?
Look, I think maybe as South African investors, we got used to let's say very good assets, companies that are operating at the bottom end of the cost curve, and they have been in business for years and years, and I guess I guess you got a point in terms of the universe, because for a South African investor just looking at the South African market, when you look abroad sometimes and you don't do proper research on these companies, and there's extremely wild swings on some of these names. You can get carried out very quickly. I guess that the tendency sort of to get that type of thinking on is not totally wrong. But I think when you look at a local stock, say Anglo American, you got to be able, when you truly believe you want to take an overweight or position or take a reasonable position in that stock, you got to be satisfied that stock ranks well on a global basis against the Xstratas, against the Rios, against the other companies, because you're 100% right. A investor sitting in London, he's got all those shares to his available to him. So, and if you don't sort of get into those names in a global context, you may get it very wrong, and that's one thing that we do. When we look at these companies, we definitely benchmark them against some of their global peers to try and assess where do they actually fit in from a global platform.
Yeah, Kobus, I'm struggling to be positive here because I'm looking at the factors affecting the industry where you are, and then we're talking about China being consuming 2/3 of the world's iron ore, and so that's one big customer. If it falls, you're in trouble. We're talking about competition. We're talking about increasing regulation. We're talking about commodity prices under pressure. We're talking about resource nationalism across Africa. It does seem like there are more headwinds than there are reasons here to be positive and bullish about the sector.
Look, and the share prices tells you that. If you look at their ratings from a price earnings multiple or a price to book or some of these measures, if you want to, they definitely don't sit at very stretched levels. They are anticipating that we're going to see commodity prices coming lower, that we are going to see margins coming lower and earnings coming lower. I guess the one area where you want to try and assess your risk when you invest in these companies is the longer term theme still intact, i.e., the developing market industrialization that we've seen. Obviously, from China's perspective, we've seen them slowing down dramatically this year. I guess a steel demand this year could come in even below 4% growth for 2012, whereas we've seen a number closer to about 10% in 2011 on a year-on-year basis. So, and I mean, it's no secret. I mean, you can look at power consumption and at the lending, the growth rates in lending, and many other aspects in China. And I guess the big factor at the moment that's affecting that is Europe. China is currently exporting around about 60% of their goods is destined for Europe. And the contagion effect of Europe is having a noticeable effect, obviously, on China and Chinese growth. But if you're a believer that the industrialization process has still got a couple of years to go here, then there is a theme in these shares at current level.
I take coal. I mean, we had thermal coal, ex-Richards Bay, at over $100 not too long ago. We're now below 90. And if I look at some of these coal counters, not just the pure players, but also in the larger groupings, it's as though coal is being priced for around about $60, which is break-even territory, and much below that you're in a loss-making situation. If you take the mix between, say, Eskom mined coal and export quality coal, which suggests, I mean, Coal of Africa's share price shows it, that the market's pricing in not quite a doomsday scenario, but an extremely negative one that flies in the face of what could argue cogently being a emerging market industrialization story.
Yeah, the market is very cautious here. I mean, it's seen the movie in 2008. It's still very fresh in investors' minds. And, to what level we'll see the slowdown playing out is to be seen. I think, it doesn't matter where you look at the moment on the globe, there's risk around. Be it in the US, be it in Europe, be it in China. And the world is dependent, different countries in the world is dependent on each other.
So at times like this, how do you manage your investors' perception of what you're doing and their expectations?
Yeah, so it's exactly that. You would say to an investor, you got a common belief here. If you believe the Chinese industrialization is over, steel demand has peaked out, we're going to see, that sort of coming off, then I wouldn't recommend investing into resources at this stage of the cycle.
Yes.
I think one got to be clear about that. We are not of the belief of that. We believe there is more legs in that. But as an investor, what you get into when you sort of do these purchases.